Welcome back. 10 minutes left in the trading session here. And just a reminder, the Dow needed to be up 21 points to hit an all-time high today.
Yeah, it looks like that's not going to happen. The Dow is closing out, it looks like, down 50 at this hour. Still got a few minutes to go. Also lower for the week. The Nasdaq was pretty much holding up all week. It is flat, but has gone red just in the last hour here. Joining us with their view of the market right now, Martiak from Premier Wealth First Allied, and David Darstein, independent investment consultant. Nice to see you both.
Nice to see you, Bill. Nice to see you, sir.
So the jobs report headline looked pretty good. You looked at the fine print, not so good. Market.
What's not to like? Consumer spending, consumer confidence. The jobs numbers on the headline, which adds to confidence. On the industrial side, the Chicago Purchasing Managers Index above 60. You've got the Philadelphia Fed. You had the lead economic indicators, the durable goods orders. On the negative side, profits have not knocked the ball out of the park. China is still going to be going through a slow period, and Europe is continuing to flirt with deflation. The yellow brick road was really about the gold standard. That's the symbol of the yellow brick road.
Right.
Disney's movie Frozen is about global deflation.
Wow.
And you've got to be careful.
Wait a minute.
Yeah.
We got to think about that one.
No, but that's the worry in Europe and in Japan and the United States, is that inflation is too low.
It's sort of a nice recap of everything that's going on right now, globally, positive and negative. Mark, are you surprised then to see these markets finish the week negative, given what you started out with, which was pretty solid jobs report?
David makes a good point on many fronts. There's great economic data right now, but market valuations and geopolitical risk are offset by accelerated M&A activity and better corporate earnings. So I'm not surprised, because we've had choppiness over the last, let's call it most of the month for them, of April. And there have been outflows from equity funds the last 2 weeks, consistent outflows into all fixed income categories.
And the market, let's face it, has been defensive for the last month. It is the defensive players, the utilities that have done well here, the dividend payers, the bond market. Look at the Treasury, the 10-year note today, just today, falling back below 2.6%. So they're looking at this sort of from a glass half empty point of view right now.
Bill and Sarah, the energy stocks are up 5% this year. All 5% of it was April. That's just as you said. That's a defensive, dividend-oriented area. We do like I like the master limited partnerships and Europe. So look at those two areas. They're performing well, and I think you can stay with the areas that are doing well right now.
It really is a mixed bag. I mean, when you look at GDP, I just want to pick up on the earnings theme that David brought up here, because we're now 3/4 of the way in terms of 75% of companies reporting earnings. Profits better, revenues. Are they enough? Is it there really to show that
73% have beat the consensus per earnings per share, the estimates. So 73% of the over 50%, or like you said, 75% of the S&P 500 that have reported, they have beat the consensus per share earnings that were forecast. So.
You'll love this. The S&P sells at 1.67 times sales, which is double its long-term average. So valuation is a concern relative to book value and relative to earnings and to sales. They're double the long-term average.
Looking a little rich there. Guys, stick around. We're going to talk more about this and look ahead to next week. I know Darst's got the whole calendar in his mind right there, and he'll recount for us what to look for coming up. We got the countdown here in just a moment.